Alrighty, welcome to Chapter 3, Learning Module. Chapter 3 is about recording accounting transactions, so let's go ahead and get started. So we've been working with the accounting information system since we began with Chapter 1. A company's accounting information system is the system that identifies, records, summarizes, and communicates various transactions of a company. So far, you have seen that when we've prepared the financial statements. What they start with in this particular textbook is they start with the reports, and now we're going to learn how you get the information in the reports. In Chapter 1 and 2, you learned how to prepare the financial statements, but you don't know where the numbers came from because they gave you the numbers. Now we're going to learn where the numbers come from. Accounting information systems vary widely, ranging from manual, pencil and paper systems, and in some organizations to highly complex electronic systems. And that is what big companies use today. In fact, all companies, whether they're large or small, probably use some sort of computer system. I'm sure many of you have maybe heard of a system called QuickBooks, and that's exactly what it is. It takes this accounting information system and it puts into, and Intuit has put it into a really simple way to enter your data in a computer and spit out financial statements. Next, when we talk about the key components in the process of capturing the accounting information, we need to take a look at three or at least three components in the process to capture accounting information. One is the accounting transaction, and that's defined as any economic event that affects a company's assets, liabilities, or equity at the time of an event. Second, we have the account, and the account is an accounting record that accumulates the activity of a specific item and then yields the item's balance. And third, we have the chart of accounts, which is simply just the list of accounts that that particular company uses to capture its business. Examples of accounting transactions include the purchase of equipment, the consumption of supplies in operations, the issuance of debt or stock. In each example, the event increases or decreases a specific asset, liability, or equity of the company. For example, a company's cash account is increased and decreased as cash is received and paid, and shows the amount of cash held at any point in time. So as we go through the process to capture accounting information, we need to remember that we're going to have an accounting transaction, which is that particular event, like purchasing equipment. That event then causes us to enter information into an account. As far as purchasing equipment, we would enter that purchase of equipment into an account called equipment or property, plant, and equipment. And in that account, it will accumulate a balance that we can look at any point in time. So let's go ahead and take a look at the chart of. Here is an example of a chart of accounts. It lists the assets and then all those accounts that are assets underneath it. The number sequence can be 100, it could be 1,000, it could be 10,000, it could be 1, 2, 3. Typically, we start with the 100s for assets, 200s for liabilities, 300s for equity and retained earnings, the 400s or 4,000s for revenues, expenses, 500s or 5,000s, and then dividends. You can set up any system that works for you. A lot of times now this is all driven by computer programs. A chart of accounts is simply a list of the accounts that the company will be using. What we have here is, you'll remember we've been working with and talking about the basic accounting equation, where assets equal liabilities plus equity. That's the basic accounting equation. So assets must always equal the sum of its liabilities and equity. Any change to this particular equation must be accompanied by a second change. So that means, and what you will hear me say often, is what you do to one side of the equation, you have to do to the other. So that means if I increase assets, then I either have to increase a liability and or equity. Sometimes you might need to equal both of them to equal the asset, as long as this equal sign says true. So what you do to one side of the equation, you do to the other, because it always has to equal. So if I increase an asset, then I have to increase something or a combination of somethings on the other side of the equation. Now there are exceptions, and we will talk about that as we move forward. So we call the dual nature of accounting is what we're talking about when we talk about that we must stay in balance. What we do to one side of the equation, we do to the other. So if a transaction increases an asset, then the equation to stay in balance, the transaction must either decrease another asset, so that's the exception. I could do an increase of one asset and a decrease of another. An example is I am increasing cash. Actually, let's go backwards here a minute. I'm going to decrease cash and increase supplies. Both of these accounts are on the same side of the equation, on the asset side. So therefore, I'm just exchanging one asset for another. That's what they're talking about here. Or I have to increase a liability or equity account if I don't do this. And we're going to walk through several examples here in this slide module, and then we're actually going to have an opportunity to work through an example together. So here's some examples of transaction. The transaction or event is right here. After incorporating, Circle Films issues 3,000 shares of common stock to investors for $15,000 of cash. So over here, if we're going to go ahead and apply this to the accounting equation, we increase cash by $15,000 and we increase equity. Here is the asset side, and here is the liabilities and equity. What you do to one side of the equation, you do to the other. Okay? And then we do a balance. Transaction 2 says Circle Films purchased a video camera for $9,000 and memory cards for $1,000. So the total amount of our transaction is $10,000. And you can see here we decreased cash by 10. We then added 1,000 to supplies and 1,000 to equipment. We didn't do anything on this side of the equation. Remember, the rule is what you do to one side of the equation you do to the other, with the exception of when I am exchanging one for another on the same side of the equation. So in this case, I exchanged cash for supplies and for equipment, and you can see here that our equation still balances. The next transaction says Circle Films receives a $2,000 deposit from a customer to film her parents' 50th wedding anniversary. So the event is a $2,000 deposit. You can see here I increase cash by $2,000. And then a deposit is considered something we call unearned revenue. Unearned revenue. It's unearned because I have to go and film the wedding anniversary before I earn it. At this point, Circle Films was given a $2,000 deposit to reserve their spot to come film the 50th wedding anniversary. And because it's a deposit, we're going to put it in unearned revenue until we earn it, which we'll learn what to do with in Chapter 4. And unearned revenue is a liability. Let's think about why that's a liability. If I don't perform the service of filming the wedding anniversary, then I will have to give back the $2,000. Therefore, it's a liability until I earn it. So now you see when we do it this way, we've got $18,005 over here and $18,500. We are still in balance. Number 7 says Circle Films purchases another $9,000 video camera by signing a 2-year promissory note. Interest is going to be charged at 6%. So in this case, we increase equipment and we're going to increase notes payable. What you do to one side of the equation, you do to the other. You add these up, we get $37.50. Now, the tricks in doing this that you're thinking to yourself, how do I know? The transaction or the event is always going to give you the account names that you will, we call it post the transaction to. Okay. It will take practice to know with what goes where. And that's what we're going to do in learning module number 2, is we're going to walk through an exercise in the book. I'm going to give you an Excel spreadsheet that I've prepared for you that I want you to print off a blackboard. Have it in front of you as we walk through this next problem. I'll see you in a few minutes.